In trading, knowledge is power, and lack of knowledge in what you're doing can be costly, very costly. So you need a solid foundation of quality market education. Whether you're new to trading or a seasoned veteran looking to add advanced strategies to your arsenal, there's always something to learn and something to improve on. And now you can access the same knowledge that professional traders receive with Market Rebellion's Trading Education. I'm Bill Johnson, Head of Options Education here at Market Rebellion, and we've assembled a comprehensive curriculum based on decades of real trading experience, covering everything you need to know about trading options from beginner to advanced. We go way beyond the nuts and bolts of options theory to teach you how to apply specific trading strategies and the techniques needed to adapt your trades when markets shift. Regardless of your goals, you'll gain access to the education you need with easy-to-consume lessons so you can learn to trade with confidence, enhance your knowledge, and master the practical skills required for market success. So please join us for in-depth trading education only from Market Rebellion. Hey, good morning, Market Rebels. It's that time again for another edition of a very spooky Coach's Corner, our Halloween edition, or should we call it Roach's Corner?
Nice.
We got to do it in the spirit of Halloween. Come on. But anyway, it is, we're doing another early recording. Normally we do this at 4 p.m. on Thursday at the closing bell. So we're about, 45 minutes till the opening bell. What are we looking at? This is on Wednesday, by the way. I know we got big earnings, but how are we looking for the future, Stu?
We're looking kind of up small, quarter 1% maybe, but we do have a couple earnings coming out tonight. Microsoft, Google.
Yeah, a number of big names. Well, we also have what today at 2?
We have the Fed.
Fed, yeah. So don't be shocked if we see a sideways motion here up until 2 p.m., but that's going to be interesting to see what happens at 2 p.m. So at any rate, for today, we have a very special edition. I think they're all special, but this is a topic that we've been talking about recently, and I think it escapes a lot of people's, the intuition, what we're really trying to say. And so let's start off with our chalk talk. So this is our little thought-provoking question. And for today, we have question that says support and resistance lines show levels of buying and selling pressure. So you're looking at your, let's say, flat lines. We see that there's been a number of hits down below, number of hits above. Is that what it's showing? And if it is, do you have confidence in maybe selling naked puts because it's not going to fall below? Look at how strong that support is. And that's kind of what we're getting at here. So we want you to just think about that. And how much confidence would you have if you have what appears to be a very strong support or resistance level? Or maybe even moving averages. We're going to talk about those as well. But this all comes under an umbrella that Stu and I talk about all the time, respect the tails. That's kind of a little catchphrase that we use, but again, I think the meaning really gets lost. What we mean when we talk about respecting the tails. So if you get through this, number of some technical details, but we think it's one of the most important things you can understand as a trader to make better decisions. So to kick things off, Stu, let's talk about some simulations. I did this in Excel. We've got a $100 stock, 250 trading days, roughly the number of trading days in a year. And here are a lot of possible stock paths. This is at 20% volatility. And if you look, it kind of looks like there's this invisible fence up here, maybe at around 160 or so, and down here around 40. And the answer is that's true. If we were to divide up these ending prices, what are we usually called terminal prices, and looked at very small ranges, maybe a few pennies or 5 cents, and we were to plot how many times these stock paths hit in those little bins, what would we get? We'd have a center, we'd have an average, and we get a bell curve. And so what it shows is that, yes, this becomes, in the aggregate, in the big picture, fairly predictable. It's, relatively speaking, easier to predict ranges than an individual path. Now, let's do a couple of little interesting mathematical points here. I find this so fascinating. Now, think about this. How many paths are there in here, do you think? Or could there be?
A lot by
A
standard.
lot is true. But now, mathematically, and I know this sounds weird, the math people will all get this. Mathematically, there are, at a minimum, two different levels of infinity. There's actually an infinite number, but there's two basic levels. There's one that's called countable, which means that no matter how big of a number that you can think of, you could count up to it, right? It's still a number. Given enough time, you could still count all the way up to it. But then there's another type of infinity that you can't even count. Kind of weird. I know it seems strange, but the number of stock price paths that you have in here is of the uncountable kind. So I want you to think about that for a moment. Even though it looks like we stay in this range, if we were to do this over and over and over, we would never have the same path twice. So take one of these, like this blue one up here, just because we can see it. If you're trying to predict which path you're on, which is what most traders try to do. Oh, I can see my Fibonacci extension tells me it's going to go here, or that I'm predicting this is going to be the path. What's the probability of that happening if there's an uncountable number of these guys?
I'd say it's pretty, you know
Zero.
what?
It is zero. You have a 0% chance of predicting that path. And yet this is what so many people try to do. But once we understand a bell curve, we can get really good at predicting ranges. And that's why you and I really try to tell people, let's try to look at the relatively easier thing to do. Let's predict ranges or think about ranges as opposed to where do you think the stock is going? To which Stu and I always go, have no
I
idea.
don't, I
This is
don't know.
why. This is why we say it. And even though there's people out there who are going to pound the table and say, oh no, I know where it's going, they don't. All right, so the first thing to understand is that think about ranges. So once we understand that stock prices move in a bell curve, roughly speaking, we know some properties of bell curves. We know this blue area right here is what's called a 1 standard deviation mark, and about 68% of your data, regardless of the mean and the standard deviation, 68% are going to fall into that blue area. Highly predictable. 95% will fall in the blue plus the gray area. And then we usually just say essentially all. It's about 99.7 that goes out here. Now, these little standard deviations keep on going. There's a fourth, a fifth, a tenth, a 20th. But after the third, as you can tell, not really worth talking about much. There's just so little area out here. But these areas in red are what we generally call as the tails.
Bill, let me make a
Yeah,
quick
of course.
distinction. So a lot of people kind of get lost in some of this right here. So where the gray area is, where Bill's talking about, where this 95%, people, when I say to people, well, what's the probability out there? They tell me 95%. And they're looking at it, like they're looking at it backwards. Maybe they're thinking about it right, but they're saying it wrong, or maybe vice versa. I'm not really sure at this point, even still, but let's make the distinction. As you're moving away from the center, you have two sides. You have the left side and you have the right side. And while the total encompasses 95% of the move, the probability of that gray area move gets split in two on either side of 98. And the difference between 95 and 68 is like 27, which makes each one of those about a 13.5% probability.
Correct.
So when you say what's the probability of the second standard deviation, the answer is 13%, 13.5%.
On one side, right?
On one side. And as you go into that third, it's like 2.2 and so on and so on.
Correct.
So the point is, which is what we're trying to talk about here, is that as you move further away from center, those probabilities become lower and lower and lower.
That's right. And these are just general, these are what are called inflection points, these standard deviations. But we could say, what's the area just from here to here? So maybe these are stock paths, maybe these are stock prices between
Yeah,
110 and 112. We could
yeah,
figure that out. So
you
don't think
can.
that we only have these great big blocks. Once we have any boundaries like this, we can figure out any of them.
Yeah, I kind of call it like a sliding scale,
Yeah,
it
right, right.
doesn't
That you
jump
can
from
think
one to the other, it just slides into the next
absolutely.
one.
But the thing to understand right now is that we have roughly, if 95% here is blue and gray, 5% is in red. So about 2.5% is up here, and about 2.5% is down here. Now,
Right.
that's low, but it's not zero.
It's
And
not zero.
that's what we
It is
talk about
not
when we
zero.
say respect the tails. Do not think that just because it says that there's a 98% chance that the stock's going to be in this range, that means it has to be there.
No,
If there's a 98% chance for it to be there, there's a 2% chance that it won't be, which means 2 out of every 100 on average, you're going to be wrong.
that's right.
And you have to ask, can I survive if I'm wrong?
And look, this kind of goes both ways. If
Oh
there's
yeah.
a 2% probability out there in the third standard deviation, then you can, if you want to create the sale and the obligation out there, maybe by
Yep.
selling a put, that's fine. But also understand that the other side of it is, well, if I'm buying that out of the money put or out of the money call, I also have a lower. It's the same trade. It's just the other side of the trade. I
That's right.
also have a very low probability of an occurrence. So don't get shocked when that way out of the money call doesn't really pay off.
Or if it
It's
does, you
price.
sell that covered call and say, there's no chance that it's going to go in the money. And it does. And people say, what do I do now? Well, there's nothing that you really have to do. That
No,
was part of the trade. That you shouldn't
that's
be
right.
completely shocked
No,
that
not
it
at
went in
all.
the money.
That's
Right.
right. See, while the low probability existed, sometimes it paid off. Sometimes it pays off.
That's right.
So you kind of have to go into it just thinking to yourself as a trader, well, this is just a a 30 to 1 bet at the racetrack or 20, it's a very high payout and a very low probability. It
That's right.
might pay off, probably won't, but it might. And from the same side on the sell side, it probably won't pay off, which would be good for you as a seller, but it might. So if you're going into it from the long side, just know that it's a real low probability bet, and it's really just a lottery ticket.
Yep.
And on the other side, you do have an obligation that has a low probability, but like Bill said, it's not definitely not zero.
Not zero. Now, once we have our bell curve, we can get different shapes to them that depending if we have a fairly low standard deviation or a high standard deviation. Now, in the stock market, we call that volatility. So let's say we have a $100 stock. The red curve and the blue curve have the same average in terms of bell curves or in terms of stock prices here. They would share the same stock price.
Yeah.
But if this is a low volatility stock, its bell curve is going to be very tall and skinny. And if it's a higher volatility, then we have more areas. So the red area is saying that we've only got this range right here, most likely that stock's going to fall into. If we have a higher volatility, we have a wider range. But
See,
those
that
those
that's
sti-
that's what volatility means,
that's
everyone.
exactly what it means.
It's about range. It's not about direction.
That's
It's
right.
about it's about range. So if those are stock prices, those are stock prices on the bottom. Maybe the red area is not, I don't know, I'll make it up, 95, 105,
Yep.
and blue areas might be 90, 110, right? It's just a wider range.
Wider
And
range.
and the prices of options are that they are reflecting these implied ranges.
That's right.
That's what the prices are. That's the straddle, right? That's the at the money straddle,
And
trying
that's
to say this is what we think, we being the world, really, the crowd, the marketplace, but they think this is what we think the one standard deviation move could be in the future in that time
yeah.
period.
And that's why if we have a $100 stock that's a low vol, let's say 20%, those options are going to have one set of prices. But we could have another $100 stock with a 40 vol or a 50 vol, and those options come with higher prices. Why? Well, one way to think of it is that the calls have the ability to have a higher payoff. because we have
Mhm.
more area out here. And the puts
As,
have the ability to have
yeah.
more of a payoff. That's one way to think about it. So therefore, the options, calls, and puts should carry higher prices because we have a wider range. But again, this is where traders, the professional traders, focus. And what do most retail traders do? Well, where do you think the stock is going? Which path do you think we're on?
Or how about this one, Bill? We get this all the time. Well, how much volatility is what? How much implied is too high?
Is to,
And should I sell it here?
yeah,
Is it a buy?
yeah,
Is it, like what's the range where I should be a buyer and a seller of implied vol
right.
or
Go
like that?
barking up the wrong tree. And yet that's what so many people do. So we want to show you why, a little more of an in-depth reason why we tell people you got to respect these tails. Before we do that, quick reminder, marketrebellion.com/get started. Over 40 courses there, Stu. We have lots of videos and articles on topics just like this to help you get started. So let's talk a little bit about random walks. Now, this is more of a mathematical idea where if we, let's say, flip a coin, heads we take a step to the right, tails we take a step to the left. We're just wandering around with no rhyme or reason. And that's where it gets its name, as a random walk. And the stock market is, for the most part, a random walk. So the thing that you have to understand as traders is that random walks create their own turning points. There's no buying or selling pressure required. That's not to say it's not due to buying or selling pressure, especially if there's big news on it, but it's not required. And that becomes a hard thing to figure out. But once you realize that there's no buying or selling pressure required, or no outside force from traders, it'll make you think twice. Is it possible that we could hit those tails? Now,
Possible.
there's a related topic that we can get illusions from moving averages. And really, all forms of technical analysis creates its own support and resistance levels. Kind of weird. Again, no outside force from traders is required. Now, the more complex the possible price paths, such as with stocks, the easier it is to mistake noise, in other words, meaningless nonsense, as a signal. So moving averages create their own patterns, and they also create apparent predictability even out of what's called uncorrelated, or let's call it nonsensical data. But yet, traders mistake these for high probability signals. Kind of weird. So to put it into perspective, let's bring up an Excel spreadsheet here. Talk about some of these things. Let's start off with a random walk. Now, we've done this in our Q&A classes. And over here, I have 10,000 flips of a coin. And we're going to, let's say we're going to flip coins, and I'll pay you $1 every time it lands heads, and you'll pay me $1 every time it lands tails. And so we're going to mark Stu's winnings or losses here on this black line. Now, the green lines are plus and minus 1 standard deviation. The red lines are plus and minus 2. So here we go. We're going to flip 10,000 coins, and let's do F9. Excel's going to come up with another sequence. And again, just like those stock paths, you're never ever going to see the same sequence twice. But they kind of all have a similar look. There we got outside the 2 standard deviation mark. You're going to find out that's fairly rare. Came down and touched it. All right, but what are some other characteristics that we're seeing of this? Well, if you look at this, now keep in mind this is completely nonsense. This is just flipping a coin. And yet, look at this. We can get support and resistance levels. You can get Fibonacci retracements. You can get MACD crossovers. You'll get everything that shows up in the stock market, even though it might be pure nonsense. So we also get turning points. So is this caused from selling pressure right here? No, it's nonsense. It's just a coin flip. So now another question is, why do we get turning points? If there's no buying or selling pressure in here, how come we have turning points? Why do these turning points tend to stay within 1 standard deviation? Those are really good questions. And once you understand that, it'll make you think twice about what you're looking at with a stock chart. All right, so let's take a look at this second tab. And first of all, to kind of explain this, this is what's called a statistical compression, is what's causing these turning points. And what's really happening, even though it looks like selling pressure, and that's what a lot of the news will tell you, might be true, might not, but it could just be pure noise. But the reason that we get these turning points is that out of all of the possible stock price paths, remember there's a lot of them, more of them lead towards the center. And so as you start moving away from the center, fewer and fewer lead to higher and higher paths. So what's more likely that you're going to end up on that, only 5 paths or 3 or 2 or the 100 that are down here? Statistically, you're going to eventually end up on one of those paths that have far more, let's call it heads and tails, than just all heads. So here's what statistical compression looks like. Now what I did here, Stu, is I did 10 coin flips in a row. Look at that, 1,024 possible combinations. And so here are this whole list is every single combination that could happen if you flipped a coin 10 times. Flip a coin 10 times, you can all do it right now. Whatever sequence you get is in that list, guaranteed. But now let's take a look at those that start off with 6 heads. And let's say that heads is up. So our market right now, we went up, 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 up. Here's another price path where we got, let's call them 6 days of up or 6 months of up. It's just some type of an up. But in order to continue going up, what has to happen? We have to have more heads than tails. That's the only way it's going to propel higher. So given the fact that we're in this block today, we're looking back, we go, man, I've had 6 weeks or 6 days of straight up. How many are going to continue? Well, that would be this block over here. Okay, so that would be that block right there. So now the question is, here's one where we get 4 H's in the top. That would propel us higher. This one has 3 H's. There's one tail out there, but that would push us higher. This one has 3 H's. There's one tail right there. And this one has 3 H's. That would also push us higher. But any other combination, if we get 2 tails or 3 tails, is going to either make us level off or turn south. And how many of those are there? There's 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11 out of 16. And there's 5 out of 16 that push us higher. So what's more likely? That we head off on one of these green paths or one of the reds?
I would say one of the reds. But
one of the
Bill,
reds. Now, and even if we didn't, then the argument now takes place into here. And now all you're doing is you're always compressing the number of available paths, and far more of them have combinations. And that's why you will eventually get turning points all by themselves, no buying or selling pressure required. This is an absolute statistical, mathematical inevitability.
So Bill,
yeah.
There must be people out there who are thinking to themselves the following. Well, that might be true. However, let's see, how can I say this? However, each successive flip of the coin
right
has nothing to do with the previous flip.
Correct.
So therefore, each one is completely independent from the other. So how can it be that the next flip has a lower chance of being a heads than a tails?
That's a very good point, and there's a subtle distinction because, all right, if we go back to here, now if we say we had 3 that were, or I'm sorry, we have 1 that was all heads, but we also had 1 that was all tails. We had 1 that was 3 heads and a tail, and that was matched by 3 tails and a head. This is just the reflection principle. We have 2 heads and 2 tails, followed by 2 tails and 2 heads. Nope, right there. So they all have to reflect. So yes, the probability of any given flip or of any given path is 50-50. The difference is once you are on a given path, here 6 in a row, to continue higher, we need more heads. That's the distinction. So I need 3 heads out of 4, and that's only going to happen in 1, 2, 3, 4, 5 cases out of 16.
Which is completely opposite of, well, that, might be heads or tails on the next one.
Exactly. That's
It drives
part of
the
it.
weight.
And that is true. There, each of those situations is a 50-50 shot. But that's not the issue we're looking at. We're saying we want to continue to push higher, and that requires more
More
heads than
heads and
tails.
tails. Got it.
And that's what's going to start compressing you towards the center. So the point is that when you're looking at a stock chart and you see stuff like this, be very careful of saying, "Oh, well, you know what, Stu? I can tell that that
Yeah.
this is a very good resistance level right here." Or I can tell you've got really good support right here. I can just, my eye can see a line right there. Oh, well, congratulations. So can everybody else. It's probably meaningless, and especially that far back. But the thing that you always have to say is, what if? What if it was just by meaningless noise? Now, again, don't get me wrong. The Fed comes out with an announcement and the market sells off. The market pops. Was that market driven, news driven? Of course. But I'm talking about just through the course of day to day, and you see a little tail, a little drifting down, or a little bump up, and they say, "Oh, it's because we found support." Not necessarily. It's a chaotic
So
system.
here's where it gets a little artsy, people.
Hmm.
So 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 these lines create themselves,
That's
and
exactly right. They create themselves,
they
or at least they
create
can.
so now people see that,
Yep. And they think it was created by traders.
and and people start to trade off of it. Look, I'm not immune to this. I do it as well. I mean, this is what this whole self-fulfilling prophecy of drawing these lines and trying to predict the next move, right? This is where it's
That's
coming from.
where it's coming from.
So, so as these lines begin to create themselves, they're now there.
That's right.
And the trading community uses these points of interest
Yep.
to bounce off of in both directions,
Yep.
and these channels start to get created.
Yep. And that's a good point, Stu. So, for instance, right, we know that there's going to be turning points for the reasons we just showed. But where they're going to be, we don't know. But let's say that this is today's date. See, the illusion comes from looking back at the past, and I
Mhm.
can say, well, here's a point where we hit a high, here's
Yeah.
a point, and here's one, and now here's another. So now I've got a lot of confidence. Nope, that's because you're looking at what already happened, where those turning points are, and you're just drawing a straight line across them. But that doesn't mean it's predictive of what's going to be happening in the future, and that's what people are doing. They say, there's no chance that the stock's going to fall below here. Let me sell those puts. Look how strong that support line is. And what we're telling you is it's not as strong as you think it is. Now, here's another thing with the moving averages. To make the point, moving averages create their own support and resistance levels. So now what I did here to really exaggerate the claim, I had Excel generate, you can see right there, that's a code for, give me a random number between 0 and 1. All right, so got all of these just made up numbers, and that's what these blue dots are. So can everybody agree there's no rhyme or reason to those? It's just a shotgun blast. It's absolutely meaningless data. There's no information there. That's the definition of random. But now, if I create a let's call it a 5-point moving average, and so for every, I'm going to take that point right there is the average of those five. All right. And then that point right there is the average of those five. Right. We're just sliding down 5-day windows. And if we do that, we get this black line. And look at that, Stu. Look at these resistance levels.
It's pretty good to me.
Man, look at these support levels off that moving average. The markets just love it down here. So my naked put is down here. I've got way too much support. Really, what you're looking at is a mirage. And the reason this happens with a moving average is the nature of a moving average. It just becomes a path, what's called a path dependent type of a line. So notice this. Now, also right here in red is a 10-point moving average. What do you notice? It got compressed because we're taking more points. I mean, as an extreme, if I gave it one average of the entire list, it would be a flat line. It would just be one average. So we're going to keep compressing towards a flat line. But now the question is, where are the support and resistance lines on the red line? And so people say, well, on my 9-day EMA or my 21-day or my 12-day, I've got, which one? Pick what are you even looking at? You have no idea what you're even looking at because they create their own support and resistance levels. So the reason for this, let's look at the 5-day, 5 point. That is coming up from those 5, right? But now this one is coming from those. And what do you notice? They share those in common. So if this was high, there's a very good chance this one's going to be high. See, that's not true in the stock market day to day or with a coin flip. But when you start doing moving averages, they start to depend on what came before it. And so that's what's happening here. So I just find that fascinating. That is completely meaningless data. And yet if you showed most traders that black line, they tell you, oh yeah, my sees a very strong resistance line. Wow, fabulous technician. Oh look, oh yeah, well my eye sees a very strong support line. And what's also funny is they'll get into heated debates about whether this support line down here is at 100 or at 99.10. Oh no, it's not. No, so you got to look at the closes. I'd move that line up a little bit right there. And you're going, people, you're looking at complete noise. Or at least you might be. That's the thing. You don't know which one you're looking at. So that's why we tell people, we're not saying that there's absolutely no use in technical analysis. It's mostly a self-fulfilling prophecy. But what we're saying is understand with that bell curve that those tails count. Don't think that you've got it all figured out because you're seeing support and resistance lines or because the stock has turned the last 4 times at this level. Probably completely meaningless, especially going forward.
We had a question last night, Bill, in Q&A, if you recall, where someone said, well, I have, they gave us this whole story about how they bought them here and sold them there, and they got this $7,000 profit and blah,
Yep.
blah, 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 blah. And the question was like, why shouldn't I just sell it and take my money and go home?
Right.
And the answer that can be derived from all of this is that because that tail exists.
Because the tail exists.
And how to take advantage of that is the things that we talk about, trimming and rolling and make adjusting deltas, that kind of thing. Right. So that's when you start thinking about that, about the idea that those tails do exist, that the probabilities of those tails are not zero, that they're absolutely exist. And that flat line may look like the best line in the world, and that moving average is like, oh my God, it can't go through there, but whatever side it's on.
Famous last words.
It's just simply not true, and that things that stock prices move absolutely through those lines.
Sure.
And as traders, as risk people, we have to understand that those occurrences, while they may be an improbable event, they absolutely occur.
Yep.
And we have to be in our financial bounds, in our arena of, well, if it does, is that going to be okay?
Is that going to be okay? That's the question to ask. That's probably the ultimate message of here. Ask, can you survive it? So yeah, there was a good point with that guy last night, because let's say you buy that option at 5 and sell it for 7 and go, okay, I've got whatever that is, 40% profit. Well, yes, that looks impressive, but what if that was back when NVIDIA went from 100 to 700? So you put a couple $100 in your pocket, but it could have been life-changing money had you rolled and stayed on it. Now, you probably might have made that decision by saying, well, but the chances of it doing it are slim. That's true, but this is our point. They are there. So here's another example. Here's a pricing model. Let's say we have a $500 stock. We have a 435 put. It sounds like it's a long way out of the money, 40% vol. And people go, with 30 days, I can get almost $3 for this put. And if we look at the delta, it's not counting the minus sign, it's a 10 delta, which roughly, and I know the math people are going to say, which is true,
roughly,
it's not
really rough.
It's a rough probability of being in the money. Now, I know that's not absolutely true, but it's going to be close in most cases.
Now, to put this in perspective, 65 points off of 500 is 13%. That is a 2 standard deviation move. That is a low probability
Right.
occurrence.
But now this is why people will say, well, let me do this 10 times. There's
Yeah,
3,000 bucks and
yeah.
there's not much of a shot. That is not respecting the tails because
Uh,
think about the other side. Yes, 10%, relatively speaking, is a low probability. But now think about it like this. What if I put 10 cards in front of you, Stu, ace through 10, we're going to shuffle them up, and you're going to lose if you draw the ace of spades. Should you be completely shocked? Think that it's going to make the Guinness Book of World Records because you drew the ace?
no, not at all.
Or, yeah, you'd be like, oh, bummer, just my luck. It's a 10% chance. It's going to happen 1 out of 10 times.
In
And
fact,
yet people will look at this.
the funny part is that people would say, "Oh, like every time I buy something, it goes down, so I expect to pick the ace of spades."
Yeah, right. But that's exactly, I mean, I look at this and go, 10%. It's not, you have to say there's a difference between saying it's unlikely versus improbable or
Yeah.
impossible.
And we're not
Yes.
even talking about the Vega,
Oh, yeah,
one
no,
card Vega part of this, right? Just be aware. It's like the age old thing. Well, and we were talking about this last night as well. When what was that? BE. How much is my option going to be when BE opens at 136 tomorrow?
right,
Well,
right.
you should be able to nail that down,
Oh, yeah,
like within a quarter of a dollar.
yeah.
On a 16-point move on a 60 delta option or a 40 delta, whatever it is. So that's your job. Your job is to know where that's going to land. Your job is, hey, you want to sell that for a 35 put for 291, go for it. Bill and I would never going to be the ones to tell you not to do it. But again, we're going to be the ones that say, well, think about what happens if, and
Right.
what will it will, don't wait till the market opens when the stock takes a 10% hit or a
Right.
20% hit,
Right.
and let me, I'll see where the
How do I
options are.
repair it? Right. That's the question we
How do
get
I
hit with. How do we
how do
repair it?
I fix it? Oh, what am I going to do now? Oh, these are $15, or it's too late. There's
Too
no
late.
repair
No.
button. I'm still looking at my keyboard looking for the big R button. It
You
doesn't
can
exist.
stop.
Yeah, it's just it's not there. So
Nothing.
just look, if you think, if you say to yourself, well, this stock 500 to 400, say, is 100 points on five, that's 20%. I kind of made that 20% up, but look, it's not out of the question, right? It can be
Oh gosh,
20%.
no,
We
of
see.
course not. Of course
So if
not.
this stock opens at 400, how much is this put going to be? Well, we know it's going to be 35 bucks plus any extrinsic value that's left. So, if I sell them at 3 and it goes to 35, I'm out 3,200 bucks on a one lot. How's that feeling?
Right.
Right. And then
Now,
multiply it by the factor of how many you're doing, and then see what the numbers really are. And if
right.
the numbers are making you fall off your chair, you're doing too many, and maybe you shouldn't be doing that. Maybe you should have some sort of a hedge in there somewhere.
Right. Now, another thing, kind of a related topic, when we talk about let's roughly 10% chance of this happening, it is assuming a pure random walk. If you come out with a news announcement that says, hey, we're going to probably end up shutting down the company, and this goes from 500 to $10, you shouldn't say that's statistically impossible. It might be statistically impossible based on that random walk, but the stock market's different because that's like your bell curve picking itself up and actually shifting to a new location. And that is not what we're looking at here. We are just assuming randomness at this rate, at that volatility. So that's another important point. So, kind of in the spirit of things, I know we share this with all of our traders in Q&A. Some of our favorite memes here: the odds of being attacked by a cat with a tank are low, but never zero. And these are a special shout out to Gato y Pata, who got their names from these, and also our duck El Pata. The odds of being murdered in your own home by a psychopathic waterfowl are low, but never zero. Perfect for Halloween. But the reason we show this is for this very reason. You have to always say, yes, I know that they're low, but I shouldn't say that they're zero. And I shouldn't say they're even lower than what I think because I can see a strong support line. And all of these other things, you might not be looking at what you think you're looking at. And so these are just some good words of caution.
When you go price shopping on your matrix, trying to look for an option that you think would be an appropriate appropriate number to spend money on, and you
Right.
get down to the 15 delta option, don't be pissed off when it doesn't work
It's
out.
a 15% chance, right?
That is the expectation.
It's the expectation. That's why people are bidding for it. So quick reminder again, marketrebellion.com/get started. So that's kind of all the negative sides. And what Stu and I try to show in our Q&A, this is why we say, all right, well, let's not try to predict which path we're on. If we look at a call spread, now most people will say, well, I like this because it's a great risk reward ratio, and I think the stock is going higher. Well, the stock is down here, and you've got a bell curve up here. The chances that you're going to get up here are pretty close to zero. It's
Well,
just
I
not,
don't
it's
know
just,
about zero. I mean, let's just say they're lower.
well, they're just lower, but they're it's just not really a good statistical trade. But the thing is that if, let's say, we're part of a covered call or even a vertical spread, and it does get up here, people say, now what do I do? How did it ever get up here? Well, you shouldn't. It's not completely unheard of. You should say that is a possibility. You need to be okay with that when you set up the trade. Have the proper expectations.
So,
Respect these
Bill,
tails.
actually, they don't say, what do I do? What they say to us is, should I lift the 110
Should yeah,
call?
should should I take this off now? No, leave it on.
Oh
But
my
now,
God.
here's another way. We could come up in this direction. We have to pay more for it. But now, with the stock up here, look where your bell curve is. I got a much higher probability for profit. Yes, we still have a tail down here. I shouldn't be shocked if it's a loser. But I'm putting the odds in my side because what I'm doing is I'm playing the range. I'm not playing a specific path. And that's the difference. And so these are just some of the things we want people to start thinking about. And if you're not part of Market Rebellion in our Q&A classes, we talk about these twice a week. We'd love to have you join us. For everybody else, we will see you on Thursday. But for today, what do you think, Stu? Support and resistance lines show levels of buying and selling pressure. What do y'all think out there in YouTube land?
Eh,
I don't know what I'm looking at.
eh.
Yet a lot of people say, oh, for sure. Stu and I will look at that and go, it might be and it might not be. But don't forget those tails.
Yeah, that's all.
They are there.
They're
And so
there.
with that, we hope that gives you, as always, some good things to think about. And we will see you next Thursday for Coach's Corner. We'll see the rest of you tomorrow for Lunch Crunch Q&A, and we'll see you then.